All right, let's dive in. Today, we're going to pull back the curtain on the engine of our economy, banking. And forget all the jargon for a minute, forget the intimidating headlines. We're going to build this whole complex machine from the ground up, using 26 key ideas as our building blocks. So, let's get started.
The source material for this kicks things off with a really brilliant metaphor. It asks us to think of banking not as some big stone building, but as the circulatory system of the entire global economy. It's the network that pumps life-giving capital, money, to every single part of the system. It's what turns the money you've saved into the fuel for new businesses, new homes, and brand new ideas.
Okay, so if it is a circulatory system, how does it actually work? I mean, what are the individual parts, the pumps, the pipes, the little valves that make the whole thing go? Well, that's exactly what we're going to figure out, and we're going to start with something we can all get our heads around, our own money.
And that brings us right into our first section. Because the entire global banking machine, with all its crazy complexity, really starts with a super simple act. It starts with you and your decision to save some money instead of spending it. Every dollar that you decide not to spend today, the source calls that postponed consumption. But it's so much more than that. It is the essential, raw material for the entire financial world. Your savings, they're like the crude oil that the whole banking system refines into productive fuel.
So what happens when you put those savings into a bank? Well, first, an account gets created. That's more than just a number. It's your formal ticket into the system. Your money then becomes a deposit. Now, this is a really key idea. That deposit is an asset for you, but it's a liability for the bank. And of course, it's all kept safe in vaults, which these days are just as much about digital cryptography as they are about thick steel doors.
And right here, this is where the real magic, and the complexity, starts to kick in. Because a bank isn't just a big storage locker for your cash. Its main job is to take the money you deposit and multiply its power out across the entire economy.
This is how money is literally created out of thin air. Let's say you deposit $100. The bank is required by law to keep just a little bit of that on hand. Those are its reserves. But it then lends out the rest, and that loan doesn't just disappear. The person who gets it spends it, and it ends up deposited in another bank. And then the whole process repeats itself. This is how your initial deposit creates this incredible ripple effect of new purchasing power, which we call credit.
So you see, credit is the main product of the banking industry. It's essentially future money that you can use today. It's what lets you get a mortgage to buy a house or use an overdraft to cover your bills till payday. It's a massive amplification of economic activity, and it's all built on one simple thing: trust that you'll earn money in the future to pay it back.
Okay, let's move into section 2 and see how this all scales up. Because those same basic ideas, deposits, loans, and credit, they get magnified to a completely mind-boggling degree when we get to the world of global finance.
Now we meet two of the biggest players in that game. On one hand, you have investment banks. Think of them as the architects of the market. They help companies and governments raise enormous sums of money by creating and selling financial products. Then, on the other hand, you've got hedge funds. These guys are the elite traders. They use borrowed money and really complex strategies to try and beat the market. So one is building the game and the other is trying to win it.
And how do they raise all that money? Well, one of the most important tools in their toolbox is the bond. You could just think of it as a very formal IOU. A government or a big corporation can sell bonds to raise billions of dollars today, all based on a promise to pay it back with interest down the road. It's a foundational tool for financing basically everything, from new highways to corporate takeovers.
But look, having giant players and fancy financial tools isn't enough. For this whole global system to actually function, all that capital has to be able to move instantly, securely, and across borders.
And this is basically the plumbing that makes it all work. Electronic funds transfers, or EFTs, those are the pipes for our everyday transactions, like your paycheck. Wire transfers are the giant superhighways for massive institutional and government payments. And exchange rates? They're like the dynamic valves that control the flow of money between different countries, constantly adjusting based on how strong each country's economics seems to be.
Of course, a system this powerful and this fast is, well, inherently risky. And that brings us to the governors and the mechanics of the machine, the regulators and central banks whose job it is to keep the whole thing from spinning out of control. In the US system, the ultimate authority is the Federal Reserve. And it's so much more than just a bank. It's the lender of last resort that steps in to prevent financial panics. It's the architect that makes sure there's always enough cash or liquidity in the system. And it's the governor that tries to keep inflation in check. It really is the institutional brain of the dollar-based global economy.
Now, to try and manage all this complexity, regulators make rules. But the thing is, these rules aren't set in stone. They evolve, they get debated, and sometimes they get thrown out completely, often with huge consequences. A perfect and pretty famous example is the Glass-Steagall Act. It was put in place after the Great Depression, and it basically built a wall between everyday commercial banking, your deposits and car loans, and the risky world of investment banking. But when it was repealed in 1999, that wall came crashing down. Banks became these massive, interconnected, universal giants, which, as we saw in the 2008 crisis, meant that risk in one area could spread like a virus across the entire globe.
Now, at the very heart of all this, lending, borrowing, regulating, everything, is one single fundamental price, the interest rate. But it's not just a percentage. It is literally the price of money across time. It packs in all this information about risk, about inflation, and about whether people would rather save their money or spend it.
For decades, moving this price up and down has been the main tool for managing the economy. But what happens when you push that tool as far as it can possibly go? Zero. After the 2008 crisis, central banks basically pulled the emergency brake. They enacted what's called a zero interest rate policy, or ZIRP. And while it can definitely get people and companies to borrow more, our source points out that it also risks creating huge bubbles in asset prices and propping up unhealthy zombie companies, kind of blurring the line between a free market and a state-controlled one. So after all that, where does this leave us? What does all of this mean for the future of this incredible machine we've just built?
Well, when you step back and look at the whole picture, one thing becomes incredibly clear. The entire system we've built is based on a fundamental, and maybe permanent, set of contradictions.
Just think about it for a second. Banking is basically a public utility, right? Like electricity or water. Modern life just can't function without it. And yet, it's run by private, for-profit companies. And that combination makes it a massive systemic risk, a potential source of financial contagion that can bring the whole global economy to a screeching halt. It's necessary, it's profitable, and it's incredibly dangerous, all at the exact same time.
And that brings us to the final critical question for all of us. Because we are now entering an era where money itself is becoming programmable code. So how do we take this paradoxical machine and evolve it for a truly digital future? How do we keep harnessing its unbelievable power for innovation and growth while finally, maybe, taming the inherent fragility that threatens us all? That really is the challenge ahead.